Hey guys, welcome back to TradeX. Now listen closely, because once you understand what I'm about to break down, everything changes. You'll stop trading with the retail crowd and start seeing the market the way smart money does. We're talking about institutions here, and this knowledge will completely shift your perspective on how markets actually move. So let's dive straight in. Many retail traders make the mistake of buying at support or selling at resistance. That's backwards. These levels aren't turning points, they're pools of orders. Every bounce adds liquidity and institutions see your stops. When price hits these levels, institutions push through quickly, triggering stop losses. Retail traders get liquidated. Institutions capture the liquidity, and then price often reverses sharply. This is called a liquidity grab or stop hunt. Now that we understand how institutions grab liquidity, the next step is spotting where they actually build it. There are four important patterns that act as hunting zones for institutions. Levels where stops cluster, retail orders accumulate, and smart money sets up their moves. By recognizing these patterns on your chart, you'll be able to see exactly where liquidity sits and how it's being targeted, helping you avoid getting trapped as part of it. Let's start with the first pattern: equal highs and equal lows. On the chart, in an uptrend, you'll notice price pushing higher, then pulling back to form a swing low. Instead of breaking that low, price rises again and later returns to the same level, creating equal lows. These equal lows form because institutions leave resting buy orders below them, and retail traders place sell stops in the same area, expecting a breakdown. This creates a pool of liquidity beneath the lows. Price commonly wicks just below these equal lows to trigger the stops and fill institutional buy orders. Once liquidity is captured, price quickly reverses back upward, continuing the uptrend and showing how smart money uses these levels to accumulate positions. In a downtrend, the pattern works in reverse. Price drops, pulls back, and creates a high. When it returns to that same level, it forms equal highs, where buy stop orders and remaining institutional sell orders sit. Price usually wicks just above these highs to collect that liquidity, before continuing downward, fueling the next leg of the trend. Let's continue with the next pattern: swing highs and swing lows. In an uptrend, price pushes upward, then sharply pulls back to form a swing low, and quickly reverses higher to create a swing high at a new level. Unlike equal highs or equal lows, each turning point occurs at a different price point, showing strong momentum as buyers keep defending higher lows. Retail traders often place sell stops just below swing lows and take profit or counter trend orders around swing highs. These clustered stops form pockets of liquidity that institutions target. You'll often see price wick below a previous swing low to harvest liquidity before snapping back up and continuing the uptrend. In a downtrend, the structure flips. Price forms lower swing highs during pullbacks and lower swing lows as it continues downward. Buy stops gather above swing highs, giving institutions easy liquidity to tap before driving price lower again, often with a quick wick above the prior swing high before resuming the downtrend. Pattern 3: trend lines. In an uptrend, price forms a rising trend line by connecting each higher. Low price keeps tapping this trend line, and every touch builds trendline liquidity below it as retail traders place sell stops underneath. When price dips and sweeps below the trend line, it collects that liquidity and fills institutional buy orders. After the sweep, price usually drives upward with strong momentum, continuing the uptrend. In a downtrend, price forms a falling trend line by connecting lower highs. Retail buy stops gather just above the trend line, and price often wicks above it to take that liquidity before continuing lower. Let's move on to pattern 4: simple support and resistance. When the market is trending up, price will often pull back into the same horizontal area again and again. That's your support. It's basically a level where buyers keep stepping in. As price revisits that zone, retail traders place sell stops underneath it, and institutions patiently let that liquidity build up. When price finally dips below support, it's usually just sweeping those stops. Once the liquidity is collected, price snaps back up and continues the uptrend. In a downtrend, it flips. Price keeps pushing into a horizontal resistance level and getting rejected. Retail buy stops sit just above that level, and price will often poke above it to grab liquidity before continuing lower. Now that we've gone through the main patterns, you can start to see how institutions target liquidity in the market. Each of these levels, whether it's a swing high, a trend line, or simple support and resistance, acts as a magnet for orders. Retail traders often place their stops and pending orders here, which creates opportunities for smart money to move price. Understanding this isn't about giving trade signals or jumping in immediately. It's about staying out of trouble. With that in mind, the next step is learning how to interpret these zones in real time. By observing retail stop clusters, sweep zones, and institutional hunting grounds, you can avoid becoming part of the liquidity yourself. Always choose your zones carefully and consistently mark out liquidity hotspots on the chart so you know where smart money is active. This awareness helps you stay on the right side of the market and increases the likelihood that any future trades you take will be in your favor. Building on this, it's also crucial to understand the foundation behind these movements before analyzing specific setups. Before looking at any setups, it's important to understand where liquidity sits and how it behaves. Focus on identifying clear support and resistance zones where retail interest is high, and notice how institutional activity often targets these levels. Observing how stops cluster and liquidity builds will help you avoid getting trapped as part of it. So that's the truth behind liquidity and how smart money really moves the market. Remember, if you can't identify the liquidity, then you are the liquidity. If this helped you see the market differently, hit like, subscribe to WeAreTradeX, and I'll see you in the next one. Stay patient, stay profitable.